Good afternoon. This is Ken Long from Tortoise Capital Management with a review of the daily trading plan for June 3rd, 2011. We have a market that's in bullish normal conditions. On an annual basis, it's at the midpoint of neutral with a score of 56 on a scale of 0 to 100 using weekly RSI. 10-day NDX closed at minus 13, which is 13% below the previous 10-day trading range, so it closed at a new 10-day low. The percent stretch above the 200-day moving average is down to 4.61%, which is still bullish. However, it's rated as yellow, as this is as weak as it's been in the last 6 months. The slope of the 50-day moving average began to degrade. It's down to 0.27%, which is in the yellow. Rated as neutral, but it's still below average considering scores of the last 180 days. ADX at 13.7 is very weak and sideways, and we can see down here in the southeast western corner that that the minus DI is what's contributing to the increase in ADX, and that's makes the case for the bearish side. Looking at the gap stat, over the last 30 days for SPY, 16 times out of the last 30, the market has gapped down. 8 times it's closed lower for an average of minus 0.61. 8 times it's reversed and closed higher for an average of 0.51%. 14 times the market has gapped up at the open. 7 times it has reversed for a minus 0.38. 7 times it's gained and closed higher for an average of 0.37. So not much advantage there. The gap downs have been the bigger follow-through days, however. That's what I take from that reading. The range stat for SPY, which is the average range of the last 30 days plus a standard deviation, is at 1.48%, which is about $2 with SPY at this price. Looking at the 10-day index time series, we are back in oversold conditions, which triggers a bunch of channeling symbols to fire for the long side. SPY, the Qs, semiconductors, mid caps, and small caps. We also have overreaction signals in the same list of suspects plus DIA. Pivot point is now below 131. You can see the ATR percentage has crept above average, is now in the high range of normal at 1.16%. 10-day max pain, we've got Intel, Home Depot, DuPont, JP Morgan, Disney. Among the ETFs, it's the VIX, silver, regional banks, and semiconductors. Quite a few patterns to choose from, lots of channeling signals among the ETFs and the large caps. The triple screen for XLV is interesting, along with Procter & Gamble, Kraft, and McDonald's, which have been strength leaders. Those look pretty decent. And then also the 551W signals in Kraft, McDonald's, Pfizer, and Merck. 5-day down pattern in McDonald's, that'll be on our chart of interest discussion later. Elder Safe Zone, things got measurably weaker on Friday across the multiple indexes. Looking at the 30-day, the Dow 30 tactical summary. All these symbols over here in the red under the Tortoise NDX, those are all highlighted because they closed in the negative, and that means for each of those look-back periods, those symbols they closed at new lows. And so if you take a look at Cisco, its closing at 16 was a new low for the 12, 6, 3, and 1 month look-backs, as well as for the 3, 5, and 10-day. So it gives you the magnitude of the pain that Cisco and Microsoft, to a lesser extent, are in. Disney, extremely weak. So this is not isolated to companies here. This is a reflection of broader market conditions as well. You can see the percent winners on Friday. ExxonMobil, McDonald's, Walmart, Chevron, Bank of America, JP Morgan, Travelers. So you're looking at financials having the strength on Friday, and energy. Among the ETFs, again, you have a number that made new closing lows over the anywhere from the 3-day to the 1-month look-back periods. Many of those in the U.S. Qs, mid caps, technology, small caps, coal. Percent winners from Friday: blended commodities, gold. Gold looks remarkably strong inside here. It's less volatile than silver, and it's been a store of value. European 350 and U.S. real estate as alternative asset classes to the U.S. indexes here. Slope of the 30-day regression line, you can see it's making a new 30-day low here, and the slope has rolled over. You can see on the short-term time series it's pulling away from its 10-day moving average. We've watched that happening for a couple weeks now, so we're not surprised by this. On the percent stretch, it's now below average. It's approaching 1 standard deviation below. We've just seen it fail to make any kind of progress as the bull continues to age. It's now 2 standard deviations below average considering the last 180 days. And so now this slope down is almost as bad as it was on the previous sell-off from 3 months ago. So the decline has not been as sharp, but it has been a grinding, sliding painfulness. You can see if you were to draw a regression line channel here, the price at 130 is testing the downside of the sloping downward channel. So we'll find out what kind of market we have here when we see what happens with price at 130. If it holds, this will be an awesome channeling entry. If it fails, then we're heading into sideways conditions. It'll only take 1 or 2 days of normal selling here to get out of the bull altogether and back into sideways. So we're going to be very sensitive to those short-term price fluctuations. Range stat percentages, just for reference, for the Dow 30 plus the usual suspects in the ETFs. And the holding X-day periods, again for reference, with all the usual suspects. You can see the strength here in the last 5 days, really coming in the globals, EFA, Japan, Latin America, emerging markets at the expense of the U.S. In the quality report for the Dow 30, again I like red on the 31 to 60 day look back period, followed by yellow or white. So I'm looking at Cisco and Intel as stealth candidates here. It's getting better. Travelers is an interest going from yellow to white, gives it a divergence in the green. And McDonald's and American Express also going from white to green, give them very positive improving scores, if you will. Among the ETFs, looking at technology in Japan, favorable on the divergence, as are utilities. And healthcare select has gone from white to green, giving it a favorable differential here. You can see just how far silver has fallen out of favor. Now that makes it a French momentum candidate because of the strength in the previous 12 months, except for the last month, which has been horrible. So that actually makes it a French momentum candidate once it finds another local support level. So we'll keep that one on our radar screen. Gap statistics for reference, and then you can see using the Elder Safe Zone channel, the last 3 days have just really reversed the positive stair step up that we had 2 weeks ago. The last 3 days have just been brutal. Pivot points calculated for all the usual suspects for reference. Looking at the 30-day regression line for each of the major indexes after we've subtracted out SPY, so we get a market neutral. Here we've got improvements in technology and the diamonds. Blended commodities, oil and gold have just really taken off. DBC is just, that's a 7, greater than a 7 standard deviation move in the reversal off the bottom for blended commodities. I'm looking for more strength there as we get currency weakness. Japan has come all the way back to normal and cooling off, and now you can see the globals starting to work here as the U.S. has begun to fail. Elder Safe Zone, only weakness from Friday's price action. Top 15 winners and losers on a percentage basis for a couple different look-back periods using ETFs. And statistics for your reference for correlation coefficients. Japan's still out of correlation with just about every other part of the world. That's a quick review of the daily trading plan. This is Ken Long at Tortoise Capital. Keep your powder dry and risk measured.